Hello, everyone. Great to have you all here. My name is Denise, and I'll be hosting this highly requested event on growth investing today. If there's one phrase that captures the essence of growth investing, it's this: higher risk, potentially higher reward. Growth companies often do business in exciting new markets and may have the potential for significant returns over the long run. Let's consider the performance of the Russell 3000 Growth Index over the past 10 years as of June 2022. It measures a basket of 3,000 US stocks. The index returned on average nearly 15% per year during that time, better than both the broader market and the Russell 3000 Value Index, which measures US value stocks. Of course, sometimes that higher risk doesn't always pay off for us investors. A growth company may not realize its grand ambition, perhaps due to factors outside its control, and shares could fall sharply as a result. That's been the story for growth stocks in the first half of 2022. The Russell 3000 Growth Index tumbled more than 25% in that time, which was far more than both the broader market and the value index. So while there may be growth stocks with upside potential out there, finding them might require investors to be a little more selective. Fortunately for us today, we have the opportunity to hear one approach to finding these hidden gems. Joining us with her perspective is Tracy Ma, aka Financial Nirvana Mama. She's a DIY do it yourself investor who earned her way to financial independence thanks in part to some investments in growth stocks. Tracy shares her knowledge and experience on our YouTube channel as well as her blog, and she's here today to share her 5-step process for evaluating growth stocks with us. Hi, Tracy. Thanks for coming on here. We're extremely excited and intrigued and eager to hear all of your experience and stories. How are you?
Oh, I'm great. Thanks for having me here.
That's wonderful. Now, Tracy, your story as an investor can be summed up in one word, and that is hustle. You went from juggling 3 jobs and 70-hour work weeks to being semi retired. How did you make it all happen?
It all started this aha moment I had when I was paying off my student loans while I was an engineer and I was working 70 plus hour work weeks. And this is like me doing a lot of hustling where I was like, I had to pay off my student loan debt because I hated debt. So I worked as a tutor and as a model afterwards. And I just felt like, okay, I got to kill it off. So finally, when I paid off my student loan debt, I started investing, particularly in real estate. And then I bought rental properties across Canada and cashed them out over the years. And eventually I was able to quit my job as an environmental engineer at 35 years old, which I reached lean fire, which is a level of financial independence that lets me work on a part-time basis. Now, I consider myself a full-time investor right now, and I have this special privilege to spend my time to educate DIY Canadian investors on building multiple streams of income using stocks and real estate. And through my blog, my YouTube channel, Financial Nirvana Mama. So, and I also offer financial freedom accelerated courses for DIY investors, part-time investors in Canada, because I found it really, really difficult during my investing journey working as an engineer, juggling life, juggling kids, juggling a rental property portfolio. So this is like my main focus right now.
Now, growth stocks are helping you build your wealth, so we're all super eager to hear about your approach to finding ones that you feel have that significant upside. But before we do, let's set the table. How would you describe a growth stock?
Well, a growth stock is a company that's trying to grow faster than the regular business and growing at double digit. Um, they tend to be smaller, younger companies that don't generate much profit or revenue quite just yet, but they're still refining their product and services and building up their customer base. And they're trying to address a big market, but it's usually new, underserved, or it could be better served. So they might be trying to deliver a unique product that solves a problem that not a lot of people do. For example, a biotech firm that's developed a new treatment for a rare disease. And
Okay.
they have the potential to grow really, really quickly, and there's significant upside if they are successful in better serving this market. However, there may be a greater risk, being a growth company because they may not be able to gain traction in that market and realize their business plan than a company that has already proven itself in that market.
And we often hear how important research or doing your own due diligence is when investing in growth stocks. What are some of the challenges when it comes to researching growth companies that investors should consider?
So, growth stocks tend to be expensive by many fundamental financial metrics that measure share price relative to earnings, revenue, or assets, because those metrics only measure a company's current financial position. However, we got to think growth companies are focused on building their business to deliver strong earnings in the future. So those metrics won't accurately capture their potential if we're always backwards looking. So which can make it really difficult for an investor to understand how the company's performing and how expensive or inexpensive its share price might be relative to its performance. So with growth stocks, we also tend to see larger swings in their share price than more established businesses. It may take a growth company several years to reach its potential, and if it gets there at all, now, because the business is less established, it may be more sensitive to changes in economic conditions and its customer base, like we're seeing in 2022. So, for example, if the economy were to suffer, go to recession, we could see its customer base become more hesitant to spend more money on a new product, which then hurts the company because it has a tougher time winning new contracts, generating more revenue, and sustaining the company's growth. So it may make it tougher for investors to understand what a fair price for the shares are at any given time because the growth rates are lumpy in a difficult market. But we got to look at the long-term trend, which should be solid.
For members in our audience interested in learning more about researching growth stocks, make sure to watch our video course, Intro to Growth Investing, within the Learning Center. Now, some investors might be tempted to think about the high reward potential of growth stocks, but you stress it's the potential risks they should consider first. Why do you believe this mindset is so important to becoming a successful growth investor?
Most people think, okay, the key to successful investing is like investing in the next Google, the next Apple, which is like finding the right investment. But reality, like we just talked about, the number one factor is risk management, in my opinion, when it comes to growth investing. So investing in growth stocks is a probability game. There may be many growth stocks that just don't pan out, but then there are ones that are potentially rewarding. So by thinking the risks first and focusing on capital preservation, you hopefully increase the odds that you don't waste too much of your money on excessively risky growth investments that don't pay off. And I learned this really hard by losing $100,000. Thankfully, it was play money in high school, but it was part of a stock investing competition. And I built my portfolio based on what I thought was just upside. And I chose a ton of cheap penny stocks. And of course, it tanked. And this is like during one of the market crashes. So this was my first lesson in risk management that I never even thought about the downside, like how much it could go down before I even thought of the upside. So I always try to remember Warren Buffett's quote, which is rule number one, never lose money. And then rule number two, never forget rule number one. So one way I would suggest an investor to determine how comfortable they are with taking risks is to ask themselves how did they handle the market crash during the pandemic. If they sold all their stocks, you might have a very low risk tolerance. If you held on to your stocks, that then you might have a moderate risk tolerance. Now, if you continue to invest in stocks, then you have a high risk tolerance. And if you invested more money than you ever did before the crash, you might have a very high risk tolerance. So, in my opinion, investors with a lower risk tolerance or who are just new to investing might not want to make growth investing a big proportion of their portfolio. Like you should make it like less than 10%, maybe 5% of your portfolio, because growth investing is an advanced investing method which requires, skill, knowledge, and patience. And this is something that people may not possess, or maybe you're just not interested in research and that knowledge, right? So I would say if you're new to investing or you have low risk tolerance or even medium risk tolerance, you would just want to have a relatively small allocation of growth stocks in your portfolio so that if a large drop happens, it wouldn't have serious repercussions in your portfolio, but the large gains would be super rewarding.
Yeah, and I love how you stressed a fact about risk tolerance because that's something that we also talk a lot about in our master classes too, the importance of discovering and the determining your own personal risk tolerance. Now, we've seen so much market volatility and sell-offs in some growth stocks for the first half of 2022. Has that changed your approach in investing? And if so, how?
So in a volatile market with ton of uncertainty, I like to be more conservative in my expectations of the company's growth potential. So factors such as high inflation, high interest rates may eat into a growth company's profit margins and make it more difficult for them to grow, right? So using the growth trends from the past few years as comparison may not accurately even reflect the growth rate going forward. So I try to be pickier, like really picky about the fundamental metrics of growth stocks. So I'm considering researching further during a market downturn. So for example, I want to see a high level of free cash flow generation and low and manageable levels of debt, and ideally even with no debt. And I want to look for strong profit margins. So continuing the revenue and earnings growth, of course, throughout the downturn and pricing power. So I feel a company with pricing power, meaning that they can increase their prices even during a downturn, that means that, well, then they can actually keep their profit margins, meaning it can maintain and even raise the amount it charges for its products. So this is very important during a downturn.
Okay. And this brings us to step one in your evaluation process, sizing up a growth company's key risks. This is the initial research you would do before getting further into your analysis. What are some of the questions you might ask yourself to figure out a growth company's risk profile?
So, one question I'll ask myself is where is the company in the business development life cycle? So, for example, if it's a startup, it's in the early stages of its development, or has it been around for 10 years and more developed? Like the earlier the business is in its life cycle, there's more uncertainty. And so there tends to be about the stability of the business, which may make it riskier than more established companies, while a more mature company likely has established a reoccurring revenue, which likely means it has less reliance on raising money from investors to continue operating. So, a question I'll ask is like, what sort of track record does the company have in its business? I generally like to look at fundamental metrics such as earnings growth, revenue growth, cash flow versus debt, and return on invested capital, which is the AKA known as management effectiveness, which is how strong is their management is by looking at the ROIC. Now, I like to see a positive upward trend in all those metrics because that can suggest that the business is going to continue to grow over time. Now, this is more difficult to determine with earlier stage companies because they don't have a track record to evaluate. Now, another question I'll ask is how did the company perform during the last market downturn? So, in my opinion, a growth stock that drops massively during a market downturn may be riskier than others that drop less. It may suggest that the institutional investors are not very confident in the business model during difficult market downturns. So I like to see companies that bounce back after a market downturn because it can suggest to me that the underlying business is relatively strong.
And if you wanted to view the price performance of the securities during any market downturn, you can actually do that by heading into WebBroker under research and looking into charts. All right, step two in your process is to evaluate a growth stock's business model. So that's when you're looking for companies with a wide economic moat. What does that mean?
So, an economic moat is a company's ability to maintain its competitive advantage over the competition and maintain its profitability. So, the more competitive advantages a company has, the wider the economic moat may be. So, in my opinion, an example of a narrow moat is something like photography development business, a one trick pony. A technological disruption like smartphones made those services like obviously largely obsolete. So, in my opinion, example, a wide mode is a smartphone maker that has, subscription services, payment services that customers want. So, this may create a powerful network effect that serves as a competitive edge. So, the four most powerful economic moats for growth stocks, in my opinion, are number one is brand, which is basically willingness for the customer to pay more for the company's products. Number two is intellectual property, which are trade secrets that may be difficult for other competitors to replicate. Number three is network effects, which means that every new customer added makes the product or service more valuable. And then number four is switching costs, which is like the product and service is so difficult to find elsewhere, or it's a major inconvenience for customers to switch to a competitor. And I also believe that generally preferable for a growth company is to have a large total um, addressable market. So that means there's plenty of potential for the company to sell a product or service to many, many different customers. And this may help the company grow its revenue and earn more money than a smaller addressable market.
You can always hop into WebBroker, and under the reports, you'll find various reports that'll have assessments of economic moat and find commentary about the business model and business management. Let's chat about the other aspects. So, within a company, leadership may also be a key piece in its success or failure, right? So, step three in your process is to evaluate a company's management. What are you looking for that would give you confidence in the team?
So I like to look for the three O's when judging a management team. Okay. So the three O's are one, ownership. The company's founder is ideally in the management team, and the management team owns a significant stake in the company, which gives them, personal skin in the game, right? So there's no minimum amount of ownership I like to see in a senior executive per se, but ideally the founder or the CEO would be among the top 10 shareholders in the company. Then second O is over deliver. So the company consistently beats growth expectations, particularly on revenue and earnings growth in most cases. And then number three is overachieve. And the way I look at this is that the management team can consistently execute on a grand vision for the company over time. Now, the investor presentations available on the company's website are often a good source to find this information on the goals the company has and how they have delivered them on them. Because a lot of companies will share like a 5-year plan or 3-year plan. And if you could tell over time if they're meeting those plans. Similarly, you can also listen to the conference calls the company has, which are held every quarter, as well as the annual general meeting. And usually those are great sources of information. I feel it's important to track the management's goals against their achievements. And then I think it's super, super impressive when a management team can reach a stated goal quicker than expected.
All right. So we are in the hunt for well managed companies, thinking back to those three O's and then a wide competitive edge with the wide economic moat. And this brings us to step four of your process to consider the company's growth rate. This starts with looking at inside the company's financial statements. Tracy, what trends are you looking for?
So generally, I just want to see a consistent trend, like uptrend of growing revenue, growing earnings more than 10% a year. So I'm looking for double digit growth. I also like to see growing profit margins over time, which suggests that the company is becoming more efficient at making money. I also like to see growing free cash flow, which suggests the company has more money readily available to pay down debts and invest in growth initiatives. And lastly, I like to see the company in a position to pay off its debt within 3 years if needed, using its cash available. So I like to relate this to someone who's just earning more and more income every single year in their career. So as they progress. So if you keep increasing your salary, you want to see that you're not actually having more expenses over time. If you have more expenses, and even though your salary is increasing, you're not that much further ahead. So otherwise, they're not getting ahead. So that's the same with a company. If they're growing their revenue, I don't want to see their expenses grow at the same rate. So I like to see ideally consecutive 4 quarters of rising profitability before I would even consider investing in a company.
So Tracy talked a lot about some of the metrics she looks for in a company. So let's hop into Webroker right now to see where we can find that under their financial statements. Now, once you've logged into Webroker, you can click under Research and look up the respective company. This will bring you to the company's overview page. We can then go into the fundamentals area and view many of the metrics Tracy mentioned. We can see the P/E ratio, company's profit margin, return on investment, all against the industry comparisons or measured against its peers. Now, within the financial statements area, we'll have access to the company's income statement, balance sheet, and cash flow statement, reading the company's profit margins and revenues to see if they've been growing. We can also see other metrics such as cash flow, net income, liabilities to take a look at their debt situation. Okay, metrics found in a financial statement tell us what a company has done in the past. But where do you go to find information that might help you understand how a company might do in the future?
So I just like to use financial data websites that aggregate all the company's forecasts in one convenient place. So this makes it so much easier to have a quick overview of the information. I also like to look through financial documentation and investor presentations that the company provides on their website. So you go to the company's investor relations website. Now, some of the key documents I look out for are the Form 10Q. Now, this is a comprehensive financial report that publicly lists U.S. companies must submit these quarterly to the Securities and Exchange Commission. Now, gives investors a look at the company's unaudited financial position during the year, and the companies must disclose relevant information regarding their finances and business operations. The other one is the Form 10K. Now, this is another comprehensive financial report that must be published annually for publicly traded companies. So, some of the information companies required to document include its history or structure, financial statements, earnings per share, subsidiaries, executive compensation, any other relevant data. Now, broken down to 5 sections are business, risk factors, financial data, management discussion analysis, and financial statements. And then both of these forms can be found on the SEC's website, EDGAR, which is a library for corporate filings. Now, investor presentations will give some details into the company's strategy, goals, and forecasts, which may be helpful in evaluating its potential. I also like to watch and read interviews with the company's CEO. I think this is so under estimated. If the CEO is willing to go on YouTube or go on Twitter, that's someone you want to follow, and you could get a little bit of their personality. So I like to read the Twitter threads, analyzing the company for some additional perspective of the company, and this may assess how well the company is executing on its vision.
Now we're going on to your step 5 of your process, right? Figuring out the company's fair value. This can help investors decide when the right time to buy the stock might be. However, valuations can get very complex and subjective. So, can you share some quick metrics that might help you point yourself in that right direction?
For sure. So I like to use the simple metric, which is a price to earnings ratio measures the company's current stock price relative to its how much it's earning per share. Now it's one indicator that we can all use to gauge the stock's valuation. This is something that is actually very easy to find and in many different websites. So a historical P ratio typically measures the price against the company's earnings over the past 12 months. Okay, that's called a TTM, trailing 12 months, while a forward PE ratio measures the price against a company's projected earnings over the upcoming year. So the first thing I look at is I look for a forward price to earnings ratio that is lower than its uh, historical P ratio on the trailing 12 months. Because I like to see, like I said, a company grow, 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 make a lot of dough. So I like to see the growth stock's earnings increasing faster than it did in prior years. Otherwise, it may not have much earnings growth momentum behind it. Now, this also means an investor may be buying the stock for a relatively cheap price based on the earnings, which is expected to generate in the future, provided those estimates are correct. Now, I like to develop my own earnings estimates in addition to the analyst estimates. This gives me a little bit extra confidence, as the professionals often cover like hundreds and hundreds of stocks, and they might not be up to date on their developments, because we are the consumers, we're on the ground. And so remember, analyst estimates can also be incorrect. So the second thing is I look for a forward PE ratio that is less than 2 times the earnings growth rate of the company. So for example, if the company is growing at 50% per year, the maximum forward PE ratio I would even consider would be 100. Now, this is my personal rule of thumb based on my personal experience of analyzing many, many, many growth stocks over the years and observing the ratios that they trade for. Now, the third thing is I look for price to earnings growth rate that is less than 1. And the lower it is, the more attractive it becomes, in my opinion. So once I've done my research on the company and have strong understanding of the business and its financials, I will check if it's overvalued or undervalued. So I quickly just do this by screening, checking if the forward P ratio is lower than the historical P ratio. The company must grow, grow, grow and make a lot of dough, and don't pay too much for it. So you got to know when you're paying, it's undervalued.
And to view some of the information that Tracy's speaking about, feel free to hop into WebBroker. Under the reports area, you'll be able to find respective reports that have calculations of forward P, PG ratio, earnings growth forecasts that are from analysts that you can consider. Well, this was absolutely insightful. Thank you so much for sharing your process on evaluating growth stocks with us today here, Tracy. Remember, if anyone's interested in continued education for researching growth stocks or investing, you can always join us in our daily live master classes that are also interactive. So, without further ado, we're going to transition into our live Q&A with Tracy so we can ask her all those questions about grow, grow, grow and how to make that dough. See you all in a minute.